Welcome, my dear students, to our course International Banks. Today, we will explain chapter number 3, Types of Banks. In the first section, there is a comparison between traditional versus modern banking. So, in this case, the traditional banking business consists of deposits and loans, accepting deposits and the supply of loans. So this is the classical functions for traditional or classical banks. What about the main source of profit for these traditional banks? The net interest margin, or the gap between interest rate on the loans minus interest rate on deposits. In this case, the traditional banks, the main driver for traditional banks, profitability. So how can the bank increase the number of branches, expand in the assets? But in case of the modern banks, we talk about new terminology, which is the shareholder value, how the bank can maximize shareholder value. Before 1990s, in this case, we will classify the radical changes or the development in banking before 1990s and after 1990s. So before 1990s, we talk about high regulation levels, high regulation level. All in all, there is a negative relationship between the regulation level and the competition level. So high regulation level leads to lower competition. So before 1990s, we talk about high regulation level, so the competition restricted. Since 1990s, mainly when we talk about 1992 and the European Union integration, we talk about the regulation level decreased, so we talk about increasing in the competition. In this time, since 1992, we talk about universal banking model. Based on this model, the banking business defined as involved all aspects of financial services activity. So the bank provide full services or full financial services. The same trend happened in the USA. In this case, we talk about the development in the Interest State Banking and Branching Efficiency Act in 1994. And another trend happened in Germany. So, all in all, we talk about universal banking activity, and the bank provide full financial services. But what about the reasons to transfer from traditional banks to modern banks? The first reason, deregulation. This word deregulation. What do we mean by deregulation? The deregulation equal when deregulations equal when you decrease the regulation level. When you decrease the regulation level. So deregulation equal decreased in regulation level, so the competition increased. Reason number two, when we talk about privatization. What do we mean by privatization? All in all, in general, privatization transfer the ownership from state to or from the government to private. From government ownership to private ownership. In banks or in the business of banks, we talk about privatization in banks and banks listed in the stock market, and this has increased the competition. Number three, or reason number three, we will talk about communication and technology. Communication and technology. In this case, communication and technology, we talk about decreasing the transaction costs. And in this case, we talk about how to attract new customers, how to increase competition between banks. Recently, modern banks, not traditional, modern banks offers insurance services. So in this case, we can use this term bancassurance or all finance. bancassurance or all finance as a French term, French words. The bank provide bancassurance. In this case, the bank provide banking services and related insurance services like protection, PPI, protection of the loans, and this product, in this case, talk about maybe your loan, you request to the make insurance contract for this loan. Okay, what about the models of this bancassurance models at figure 3.1? Bancassurance models. Number one, conglomerates, and number two, distribution aliens. M&A equal merger and acquisition, may be holding, may be integrated, and insurance subsidiaries. But distribution, we talk about three categories: pure distributors, joint ventures, and agreements. This model, can we talk about some countries like Italy, France, Spain? In this case, we talk about the people visit banks on the regular basis, and maybe the preferable model is conglomerates. So, recently we can note that modern banks as a full service provider for financial services. Some banks like JP Morgan, Barclays, and these Barclays try to drop the word bank from the marketing campaign. Why drop this word bank? Because these banks, more than bank, operate as large corporate, not a bank. Table number 3.1, comparison between traditional banks and modern banks. For products, when we talk about limited equal only loans and deposits, but unlimited for modern banks, because modern banks can provide the related insurance services, can provide the securitization or the investment bank services. Income sources for traditional banks, we talk about the net interest margin or the interest rate on loans minus interest rate on deposits. But in case of modern, yes, the same net interest but plus commission from and fees from another services. Competition restricted in case of traditional because high regulation, but the competition high in case of modern because soft or lower regulations. Strategic goals, asset size and growth. In this case, we talk about supply side orientation, but in case of modern, we talk about shareholder value, how to create and maximize the shareholder value, and this is demand orientation. This example for bancassurance in Egypt, Bank Misr provide the bancassurance with the cooperation with Aliens Life Insurance Corporate. In this case, we talk about the bancassurance model in Bank Misr.